We're on the precipice of the greatest retirement crisis in the history of the world, warns pension expert Ted Siedle. The average U.S. public pension is 30% underfunded. Though reality is much worse than that when you dig into the books behind these funds, Ted says. So when, not if, but when, these funds start failing, what is that going to mean for the millions of Americans who are depending upon these funds for paying their retirement? And what kind of havoc is this cascade of failure going to wreak across the financial markets? To find out, keep watching this video. And as always, take a quick second and click the like button below to help us continue the amazing run of great guest experts we've had on this program. The more likes these videos get, the more big names we're able to attract. So now let's get started watching this week's market update featuring pension expert Ted Siedle. Hi folks, Adam Taggart, co-founder of peakprosperity.com here, welcoming you back to another week of making sense of these markets. We're very fortunate to be joined by this week's guest, Ted Siedle, who is an expert on pensions and a very outspoken authority warning about the looming pension crisis. Ted is a former SEC attorney. His current firm, Benchmark Financial Services, has pioneered over $1 trillion in forensic investigations into the money management industry with a specific focus on pensions. Ted has testified before the Senate Banking Committee in Congress on pension-related issues, as well as Madoff-related other fraud. In 2017, Ted secured the largest SEC whistleblower award in history at the time of $48 million. The following year, he was then awarded the largest CFTC whistleblowing award at $30 million. So he's done a huge amount of work already in surfacing a lot of the issues in the pension industry. Ted, thank you so much for joining us today.
Thank you for having me, Adam.
Hey, you're very welcome. Look, I want to pick up kind of right where we left off the last time we interviewed you, which was back earlier in 2019. You had said the following, and I'm going to read it here. You said, "We are on the precipice of the greatest retirement crisis in the history of the world." And that makes perfect sense because, first of all, we have the largest elderly population in the history of the world. Just focusing on the US, our elderly are woefully unprepared to retire. And in the decades to come, we will witness millions of elderly Americans, baby boomers and others, slipping into poverty. Too frail to work, too poor to retire will become the new normal for many elderly Americans. So my question here for you, Ted, is what impact, if any, has the pandemic here in 2020 had on potentially making this situation worse?
Well, it certainly hasn't helped, let's put it that way. But as you said, Adam, we are approaching the point where we will have over 2 billion people on this planet over the age of 60. And so the number of elderly is skyrocketing, and only a very small minority of these people have enough personal savings set aside to survive potentially decades of retirement. And then with COVID, we have, of course, a massive, broad impact on the financial markets, because so much of what we're accustomed to doing, people are no longer doing, and travel, hotels, things like that. So it's having a very dramatic impact, and there are over the employment by state and local governments in this country employ about 13% of the total workforce, and they represent about 9% of GDP. And state and local governments are hurting badly. Tax revenues are down, fees, taxes, expenses are all down. So that's really hurting the state and local governments, and the expenses related to the pandemic, of course, are new and unprecedented. Yes. So it's having a profound impact on state and local governments in particular, and their pensions, and then the markets generally. It's having a very broad impact.
All right, well, let's roll up our sleeves here and dig into the pension situation. So you have been on record warning about the poor condition that many of the U.S. pensions are in. So sort of two questions for you. One, can you just give us sort of your general assessment of what the current threat level is? Are we at DEFCON, 1 already? And then also just walk real quickly through sort of the economics of how the pensions returns work. In other words, when you were on the last time we chatted, you basically said, look, there's sort of three factors that matter in terms of how a pension performs. There's the amount of money you put in, there's the amount of money that you pull out, and there's what you do with that money while it's being managed in the interim. And I think people tend to be real focused on the first two things. Asking the question is, hey, have we put too little in, or are we taking too much out? But people don't really seem to give as much focus on what's happening while it's there. And you seem to say that, hey, that actually is one of the biggest issues that's going on currently in this, is that they're being so poorly mismanaged that even if the math kind of worked in theory in terms of we're going to put X in, we're going to take Y out, the returns that money is getting in the interim are really putting all that in jeopardy. Is that true too?
That's absolutely true. And by the way, a lot of this is in my book that I wrote with Robert Kiyosaki, your friend, which is called "Who Stole My Pension?" And
Great. Hey, hold that up a little bit higher so everyone can see. There you go.
And what I talk about is that there are three elements to the health of a pension, three main drivers. One is how much money goes in. One is how the money that's in the pension gets managed. And then the third is how much money is paid out in the form of benefits. Obviously, COVID is going to impact on how much money state governments can afford, state and local governments can afford to pay in to the pension, because their tax revenues are down and their expenses related to COVID are way up. And how much money is paid out in the form of benefits is something that's highly controversial and often discussed as well. But the one thing that everybody neglects is how the money is managed over time. The management of the investments in the pension over a 30-year period of time is, based on my forensic work, the leading cause of pension failures, the leading cause of the fact that today state and local pensions, for example, are on average 70% funded. So if you look at what is the impact of poor management of investments, excessive fees, let's say excessive fees to the tune of 2% a year over a extended period, 25-year period, that's going to reduce your profits, your return by 40% over the 25-year period.
Wow.
So pensions, state and local pensions are 30% underfunded or only 70% funded. Mismanagement, excessive fees is the direct cause of that underfunding. It's not a question of there not being enough money put into these pensions. It's not a question of the pension benefits being too rich. It's a question of mismanagement, which is excessive fees and other forms of malfeasance.
All right. And when we talk about mismanagement, is it more sort of fraud, or is it more sort of people who just shouldn't be managing funds or managing them? I know in certain cases, I've seen reports of like policeman funds or teachers funds where you have guys that used to be beat cops that are now sitting on the board that's making the investment decision, and they might have been great policemen, but they don't really have a lot of investing experience and they're making big decisions. So, what would you say are the main reasons for that poor management?
Well, one of the reasons you just cited is the fact that public pensions, state and local pensions around the country, have no requirements that their board members have any educational credentials, have any expertise in finance. So all of these public pensions have cops, firefighters, school teachers, garbage collectors on their boards making profound investment decisions involving trillions of dollars. So it's an unequal fight at the get-go, because you got some of the savviest Wall Street snakes coming in to sell high-cost, high-risk investments to cops and firefighters who really are not equipped to get into a a due diligence and a negotiation with some of Wall Street's finest. That's a big problem. And then there's, one of the big issues, which you're well familiar with, is the zero interest rates. So as interest rates have been artificially kept down, as the government, federal government, state and local governments can't print money. They have to balance their budgets. The federal government can print money all day long. And so what the state and local governments have been doing is, because interest rates are so low, they've been migrating to riskier investments to make hopefully better returns, and riskier investments always involve higher costs. So that is another major problem, is that the cops and firefighters sitting on these trillions in pension assets are being convinced that because of zero interest rates, they've got to get into riskier investments. And Wall Street has a solution to every investment problem, which is always pay us more in fees.
Right. So I want to dig more into the zero interest rates, because I think it really is a major dynamic going on here, where it's kind of putting both a carrot and a stick on the folks that are managing these pensions, right? So, these pensions are supposed to be somewhat, there's not even somewhat, they're supposed to be conservatively managed, right? You don't want to be rolling the dice with, teachers' retirement funds. But and that generally means being conservative, is that you're in, a lot of bonds and things like that. But because the yields on those bonds have been driven down to historic lows, there's not nearly enough yield there for the pension managers to get what they need to actuarially to keep the pension solvent. And so, to your point, they're getting forced out to chase yield, right? So they're getting into these, investment vehicles that really they've got no business being in. They add way too much risk into the portfolio, and they add way too much cost, as you were saying. They're really just enriching the bankers in the process here. And my guess is, and correct me if I'm wrong, my guess is they can kind of validate, the pension managers can kind of validate this as the prices of the bonds in their portfolio and the prices of these other instruments they're investing in continue to go up. Because we've been in this extremely prolonged, bull market. Many people would argue is a bubble at this point, an asset bubble. But my guess is that if we do have a major contraction, and we got a short, very brief preview of this back in February and March, my sense is if we went through another correction like that, you would have some of these pension funds not being 30% underfunded, but maybe going to like 60 or 75% underfunded. Is that a correct assumption, given how far into the risk spectrum they're investing now?
Yeah, there was a time, many people think that pension funds still are conservative investors that are primarily in bonds, safe, conservative bonds. And there was a time when that was true. That time ended long ago. I remember, I think it was around 1990, Indiana was the last state pension to approve equities, the introduction of equities into the pension fund. So that's 1990, not that long ago. So, but today, the percentage of pension assets invested in safe fixed income investments is minuscule, probably 10%. So it's been flipped. The whole equation has been flipped, where 90% of the investments have equity-like risk or exponentially greater equity risk in terms of hedge funds, private equity, venture funds, and other types of exotic vehicles. So it's a very risky, these portfolios are very risky today.
All right. And I just want to ask you to repeat that again. Did you say that it's flipped so much that really only about 10% on average is invested in quote unquote conservative investments, and the rest is in the sort of higher risk profile?
The rest, yeah. So only about 10% is in a conservative fixed income type investment, and the rest would be in that either have equity market risk or even greater risk because they're privately held, illiquid investments. So that are not, by the way, readily valuable. They are all a great over 50% of the portfolios in many cases are hard to value assets.
All right. And when we talked previously, a little over a year ago, you gave a couple of horror stories on those hard to value assets that a lot of these boards kind of fall victim to somebody in their local area, coming up and saying, hey, the city's going to put in the stadium here. We need money for it. And the pension's the kind of dumb money that invests big into that. And then, those are very risky investments that don't often pan out, right? And then the pension's left holding the bag. So where I'm going with this is, let's say there is a big correction, right? I'll just pick a number, but let's say the market corrects by 30% or more, right? Just what's your vision of the impact that's going to have? I mean, are we talking Armageddon here? And what happens to the greater markets when a pension fails? Because it's not just going to impact the people that are the pension holders, right? I mean, these are big whales in the marketplace that if their capital kind of dries up, it impacts all sorts of other investment types. Is that correct?
Absolutely. And one of the things your listeners need to realize is that when pension funds around the country when we say that pension funds are 70% funded, that is based upon an investment return assumption of 7.5% to 8%. So if that assumes that the pension is over time going to earn 7 to 8%. Well, of course, they don't earn that amount historically. So if you take down the investment assumption 1%, then the pension fund is significantly less funded than if you project that they're going to make 8% a year, they're 70% funded. If you project they're going to make 7% a year, then suddenly they're 60% or 55% funded. So the investment return assumptions pensions almost universally have today are actually masking a deeper problem. The pensions are less funded than you would think. And if you have a significant downturn, they will fall even more to where they're going to south of 50%. But the other thing that these high risk hedge fund and private equity, opaque, non-transparent, non-marketable investments have, the other feature is that they don't mark them to market. So if the market were to fall 30% tomorrow, a lot of these investments would not be marked down for perhaps a year or two or more. Some of these investments can be extended to as long as 50 years. So that the high risk, secretive investments give cover to pension funds that don't want to show immediate losses.
Right. So you're basically saying we can be sort of auditing these companies, and on paper they look like they're 60, 70% funded or whatever. But if they're made up by a large proportion of these assets that don't have to be marked to market regularly, that haven't performed well, sure, on paper it looks okay, but in actuality, there may be a lot less money to make those pension payments than we might realize.
Yes, and so there are a lot of faults in the system right now, and if we had another significant downturn, it would reveal a lot of the people that are using bogus values and using bogus investment return assumptions.
All right. Well, I want to bring you in real quickly, Mike, just for a sec, because I know that, in past interviews that we've done over the previous weeks and months, you and your partner, John, have done a great job of surfacing lots of charts from folks like John Hussman and other analysts who have basically crunched the numbers and said, we have had such an extended bull run that we really have pulled in all the future returns for the next decade, and that looking out with their models, the average, likely return is either zero or at this point negative. So to Ted's point, if the Hussmans of the world are right, these funding ratios are going to take a big beating, even if there's just no appreciation, right? And then of course, to your point, Ted, if we end up getting a correction in there too, it just multiplies the carnage, right? So John, Mike, did you want to say anything else or ask anything else on that point of, projected market returns in this environment?
Yeah, you mentioned John Hussman. He's somebody that we admire a lot. He does great work, and we think more than anybody, he puts out data that's pretty statistically reliable and kind of takes the emotion out of, or at least takes some of the emotion out of investing. He came out with a piece the other day that showed the lowest projected expected return over the next 12 years for a balanced portfolio. A typical 60-40 portfolio, which you might say is can be somewhat analogous to a pension investment portfolio. Although I do agree with Ted, there's a lot of what they have in there is pretty opaque and non-traded stuff that's not marked to market. But even be that as it may, if a 60-40 portfolio is going to expect a minus 1.5% annual return nominal over the next 12 years, and that's the number that John Hussman put out, it's going to be a disaster. I mean, I can't imagine how underfunded pensions would be if we even had a 0% expected return over the next decade. And the numbers really show that. Other firms like Jeremy Grantham's firm, GMO in Boston, they've got 7-year asset class forecasts, all of them basically negative. Certainly, large cap stocks are solidly negative expected return over the next 7 years. So we're still living in the most overvalued point in U.S. history based on a number of different criteria. That's how we see it. The stock market, if you look at the S&P, has been trying to put in a top since January 2018, and there's at least 8 individual blow off tops that we've been tracking over the last 3 years, and every time the S&P tries to correct, there's a more profound response by central banks, and so it's created this complacency, this euphoria that is it's just hard to describe. We talk to people all the time, and new people and existing clients, things like that, and they tell us about their advisors. The sentiment out there is that the market's bulletproof. The Fed is bulletproof. Nothing's going to happen. And who can blame them, I guess, for feeling that, because nothing has happened yet. And it's frustrating for people like us that are continuing to cry wolf, if you will, and telling people to be cautious. But expected returns in this market are solidly negative over the next decade. That we don't know what the path looks like. It wouldn't be surprising to see markets drop 60 or 70%. I can only imagine what that would do to pensions. And I know that the typical response would be, well, the Fed's got that. Don't worry about it. They'll just print another 10 or 20 trillion. We're putting all of our eggs in one basket. Like your partner, Chris Martinson, says, this is for the whole bag of marbles. Everyone's all in here. It better work. And frankly, I don't think the central banks really have a plan for what to do if this doesn't work. So we just keep spreading the word about caution, and we're very, very lightly exposed to stocks, essentially net zero exposed to stocks. And Ted, I love that you made that point about non-traded, hard to understand investments. I really think a lot of operators in Wall Street get away with, maybe doing things they shouldn't do because of the fact that in the long run, everything will be fine. And even if we have a downturn, these non-traded investments will get bailed out by a rising market. We really think that's changing over the next few years, and caution is warranted. I'd love to hear from Ted what the solution is. I don't know what the solution is, what's going to happen to pensions if we have 0% returns over the next decade, or even how to fix it. But those are just a few comments that I have off the top.
All right. Well, let's start there. So Ted, let's just assume that market returns for the next decade are not favorable, and maybe there's a correction in there or so. So if we start having these pensions that are already sort of teetering on the brink, if they really start failing, paint for us what you think happens there. What is the aftermath? Do they get bailed out by the states? Do they get bailed out by the federal government? Are the pensioners just going to be told to suck it up and receive lower payments? How do you sort of see this, what the domino effect is if that indeed happens?
Well, first, let me mention, as John said earlier, the questions about how private equity and venture and hedge fund managers calculate their returns are swirling. And most recently, Warren Buffett said that he did not find it entirely honest the way many private equity firms were calculating their rates of return. So we are not alone in this assessment that there are people who are not being entirely honest. And these opaque, hard to value assets that's the place to hide. And manipulate returns is in these opaque classes. And on the pension side, just ask yourself this. The average pension fund has an actuary. No, let me back up. Every pension fund has an actuary. The average actuarial rate of return related to pensions is around 7%, let's say. How is it an entire industry, an entire actuarial industry has concluded throughout this nation, all of these pensions are going to return 10% a year? They all agree. There's nobody saying what we're saying here. Oh no, it's not going to be 7%, it's 1%. No, they all are around 6.5 to 7.5%. So, and they are providing legal opinions or actuarial opinions for all of these pensions. And if those opinions are wrong, if the industry, the actuarial industry, has been complicit with the state and local governments and the corporations that are sponsoring these pensions to manipulate the rate of return and therefore require less money to be paid in, that's a huge global problem. And I think the answer is they have been complicit. And they are rarely, but sometimes, being sued for manipulating these investment assumptions. But that's a huge problem. And so the solution is that today, people must get together and start examining these pensions forensically. There's not a pension fund in this country that reports the fees it pays truthfully. There's a chapter in our book. It's called "Your Pension is Lying About the Fees That It Pays." They all do. And to the tune of, in the case of Rhode Island, they were disclosing fees of 10 million. After a few months of examining the fees, the pension agreed with me that the fees were in fact 80 million. And within months.
Wow, that's a big difference.
It's like 8 times. Yeah, right. It's a big difference. So there has to be an investigation into these pensions immediately on what are the investments, what are the fees, what are the risks, what elimination of the secrecy is. Transparency should always be the rule when you're dealing with public monies, right? I think we all agree. We have a Nation Freedom of Information Act laws which say public money should be publicly accounted for. So these secret investments, non-transparency, that needs to be eliminated. And there needs to be a restructuring because things are going to get bad and the problems are known, but the people running these pensions and the Wall Street guys providing services to these pensions have no interest in solving the problem.
Yeah. All right. Well, look, the reason why I'm sort of tugging on this thread is twofold. The first is back in April, Mitch McConnell, the Senate Majority Leader, he basically said that he was in favor that states could use the bankruptcy rule to deal with underfunded public pensions. And at least my sort of interpretation of that is it's sort of laying the ground for telling those pensioners that, hey, state's declaring bankruptcy on this and you're going to get, pennies on the dollar of what you were promised. Are you foreseeing, that happening with some of these more poorly mismanaged pensions?
I think it's something that will be attempted. The first U.S. pension to attempt bankruptcy, guess what it is? You'll never guess this in a million years. Saipan, the government of Saipan, which is a U.S. territory, and
never would have guessed it.
Never would have guessed. About 10 years ago, they attempted to declare bankruptcy, and they went into litigation, and I think ultimately they were unable to. But I think that more state pensions and local pensions will look into the feasibility of bankruptcy. Again, the federal government can print money at will, so the states would like the federal government to print money to bail them out. The states can't print money. So unless there is that federal bailout, there's going to be, or continuing federal funds going to the states, there's going to be a crisis. And I would say that any pension that is severely underfunded and has the legal ability to declare bankruptcy would certainly look into it.
All right. So here's where I'm really interested, sort of in the, if you game all this out, is obviously if pensions started telling their pensioners, hey, we're going to give you 50 cents or less on the dollar, there's going to be a massive hue and outcry. No politician wants to be the one being involved in the decision that says that teachers and doctors and firefighters are going to get shafted. At the same time, you said these states can't print money, so their only other alternative is taxation, right? And so to me, it seems like we've got this really predictable conflict brewing between those people who are on a pension and those people who aren't. For as long as those pensions are being met in full, and if today even, if you're getting a pension of $60,000, $70,000, $80,000, that's the equivalent of having tens of millions of dollars saved in the bank at today's incredibly low rates, right? Like the 10-year treasury is still below 1%, right? So if you've somebody who's worked in the private industry without a pension and you're responsible for having to, live off your own retirement savings, you can't really do it in today's environment. So the people that are on a pension are at a much greater advantage right now on a relative basis, right? So I think there's already some awakening, some dawning sense of resentment around that, which is like, hey, how come you get to retire in style while I've had to scrimp and save and I'm now getting screwed on that? And then of course you add higher taxes into the mix, that's just going to make that animosity even worse. And then to your point, if the government steps in, the federal government steps in and kind of prints money to make up the difference, well, that inflation creates all sorts of exacerbations in the current wealth inequality that's going on in the country. It also flows into the cost of goods and services out there. So it just seems like there's this kind of perfect storm brewing of these different interests that I just see getting more and more strained as time goes on. Are you seeing the same thing?
Yeah, I think so. But one of the things that I keep trying to emphasize is, if you look at the last 30 years of pensions, the issue has not been enough money going in to sustain the benefits. The money was going in. Unfortunately, it's been squandered every single year, year after year. And with compounding, it's resulted in significant underfunding for all pensions, whether it's corporate pensions or public pensions. But that's really, it's ironic that the question has never been, is there enough money going into these pensions? The question has always been, how is that money being managed? And if we don't fix that right away, then putting more money into a broken pension is only going to result in more squandering. So that's not, I always say that you should investigate before you legislate or litigate or negotiate. So we need to investigate what has been causing these problems. It's quite clear to anybody who doesn't have a political agenda, and fix it, because putting any more money into a leaking bucket is just going to result in more leakage.
Makes total sense. Now, you said the word political agenda. How much optimism do you have that those will get addressed, or do you fear that the folks with the political agenda will be successful in continuing to thwart that until the system breaks at a point that they can't hide it anymore?
Oh, absolutely. I think that there's broad consensus among Wall Streeters and politicians that we do not want to open this can of worms. So I think that things will continue to be, there'll continue to be this complicity and mismanagement until things get so bad that they have to change. But it is in no one's interest to have these problems addressed prematurely. I've talked to the PBGC, our federal agency that insures corporate pensions, which is about 50-something billion dollars in a deficit at this point. And I've talked to them about a forensic investigation or an autopsy of all the thousands of dead pensions that have landed on its doorstep. And the PBGC said they had absolutely no interest in forensic investigations that would uncover potential mismanagement.
All right. Yeah. Thanks. That is really depressing. Well, look, Ted, you've given us so much time on a really critical subject that I don't think was burning that brightly on people's radars. So I want to thank you for that and wrap things up to let you go here. Before I do, though, so let's say there are a number of viewers here that have been watching and are now kind of freaked out about this, right? What would your advice, if any, be to those people, whether they're on a pension or whether they're not? If they've been sort of woken up by this, do you have any direction for them?
Yeah, well, right now, as we speak in Ohio, the Ohio Retired Teachers Association is doing a crowd-funded forensic investigation fundraising now. Hopefully, it'll be successful. We'll find out before Thanksgiving, I think. But this is a group of 38,000 retired teachers that have gotten together and are demanding a forensic investigation of their teachers' pension fund. So this is something that can happen in any state, in any city, that people can get together and hire an expert to do a forensic investigation at low cost, maybe a couple of dollars each, if there's a group of them that are willing to do it. But you cannot simply sit back and expect your pension check to arrive in the mail for the next 30 years. That's not going to happen. You need to do something. And one possibility is participating in crowdfunding a forensic investigation.
Great. I'm just curious, because I'm sure we've got people watching from the state of Ohio. If they want to kind of lend support to that, is there a way they can do that?
Yes, so you can go to the site of the Ohio Retired Teachers Association, or ORTA it's called, and they have a fundraising tool on their website, as well as they show how much money they have raised to date. So please visit their website, which I think is orta.com or orta.org.
Okay, great. And two last questions for you. The first is, and I'm just looking for a super short answer here. Nobody can predict the future, so I'm not trying to put that weight on you, but if you had to kind of estimate where we are, what inning we're in terms of the pension, the chickens coming home to roost for the pensions of the country, are we still kind of in middle innings here, or is it pretty late in the game? In other words, they're not going to be able to continue you kicking the can further down the road, given how underfunded they are. So that's question number one. Just give me an inning. And then the last question is for people that are interested in learning more about you and your work, where should they go? You held up the book. If that's what they should do, great. If there's any other website or whatever they could go to too, just let us know.
Well, in terms of anybody's interested in my work, I'd suggest you pick up the book, Who Stole My Pension? And you can search my name on the internet. I have a pretty broad presence. But in terms of where we are in the game, it's interesting that Robert and I wrote this book at this time. We launched the book in January of this year because we are in the final innings, but we got co-opted by another crisis called COVID. So I think that the world was poised to focus on pensions, the pension crisis, the demographic issue, the aging of the world's population. But COVID has been a major disruptor. Attention has shifted. And I do think that when we resolve the COVID crisis, or when the COVID crisis pandemic subsides, then I think that the issue will return to pensions, because the demographics are so compelling. 2 billion people worldwide over the age of 60 with no means of providing for their golden years. That's a big issue. It's not going away. It's demographics. You can't dispute it.
Yeah, absolutely. And I'm sure everybody watching, myself included, have family members that already fall into that demographic. And, it raises lots of big questions with no easy answers as how are we going to help those people make it through the rest of their their twilight years, given the fact that there's not a lot of support on the table to do that. So, Ted, I want to thank you so much for this. I am sure that we're going to get a great response to this. I hope we can invite you on again back at some point early on in 2021 if you're game for it.
Absolutely. Be happy.
All right. Well, thanks so much, Ted. We'll see you again soon.
Thanks, Ted.
All right, Mike, I don't know if you'd seen our previous interview with Ted, but I got to think that a lot of what he said, not only must sound validating to you, but to a certain extent too, still must be a little bit startling. I'm not sure how closely you and John sort of follow the whole pension environment there, but boy, a lot of what Ted said, even though I've heard it before, still kind of makes the hair on the back of my neck stand up.
Yeah, we saw his previous presentation with you, and I can't even remember when that was, maybe in the beginning of the year. But look, this has been a problem for a long time. The pensions have been underfunded, and as Ted said, even with a very aggressive target or a return target of 7.5% to 8%, they're only 70% funded. What if we actually have a lost decade? What if John Hussman's right and we actually have a minus 1.5% return over the next decade or 12 years? There's no way. Absolutely no way that these people can be paid their promises. And he's right. The states are going to be clamoring for the federal government to print money. But if they do that, they're going to have to do it for everybody. And essentially all they're doing is redistributing our own money back to, certain groups of people. So it is going to maybe cause some problems. As you mentioned, envy and resentment could start to become an issue because of the fact that interest rates are at zero. And, many people are out there on pensions that are only achievable with many millions of dollars. So all of this is a big problem. This all ties into why the Fed thinks they have to keep doing what they're doing. They have to keep pushing asset prices up, they say. The stock market has to keep going up to justify the ridiculous mountain of debt that we have. We're approaching 27, 28 trillion here in the US. It's going to probably be 30 trillion very shortly, beginning of the year, growing by maybe 3 trillion a year if we continue with some of the economic stagnation that we have. This is at the same time that the S&P 500 has never been more overvalued and has projected negative returns for the next 10 years. So, we get kind of sick of saying the same thing and always sounding the note of caution, but we think it's the right message. We think that's what the data says. And, Ted says we have to do investigation. It was really heartening to hear about the Ohio school teachers coming together and doing crowdfunding. That tells me there might be some hope. But sadly, it really feels like and seems like that nothing's really going to happen until there's a crisis. You don't really find out who the Ponzi scheme operators are until there's a crisis like we saw in 2008. We saw some big names that were found out. And there certainly are going to be other issues that are found out when and if there's a crisis again. So frankly, it can't come soon enough to have some type of return to normalcy, some type of price discovery in these markets, some level of justice coming back to these markets. Won't be easy. It won't feel good, but it will give us the chance to hopefully fix some of the pension problems, create some structure around central banking and, maybe having a little bit more freedom in our markets. That's what we hope for anyway.
Yeah. And we, it sounds terrible to say we're sort of hoping for a market correction, but I think, at least the reason we're saying that is we want to be able to return to an era where people could trust the price discovery mechanism and, valuations that are reflected by the markets are more or less true, right? So that people aren't being forced to buy in at crazy overinflated prices that then destroy their capital when, the inevitable correction occurs, right? And so that's one of the big challenges with this pension crisis is, you mentioned the word fix some of these problems. And Mike, I don't think many of these problems are really fixable. Meaning, let's say these Ohio teachers are successful and they get a really transparent audit of their pension and they find out that it's only 50% funded, right? It's really good that they know the true nature of it, but there's no magic wand to wave that says, well, let's get that back up to acceptable levels of funding, right? I mean, other than some of the things we talked about, which would be, crazy taxes, or bailouts from the Federal Reserve printing money, and both of those, as I mentioned, come with very high costs, right? So it's just very sad because I think, to Ted's point, because of the smoke and mirrors and the exotic instruments and the incentives not to be transparent in reporting, I think most people who are on a pension do not realize the true nature of the risk that they're being exposed to. And when they finally are, whether it's because the pension fails or just the checks just stop coming at the same amounts they were, there's nothing they can do at that point except just have to suck it up and deal with it. And that is really not just at all. So there's a huge undercurrent of unfairness running through this. And it's one of the main reasons why I wanted to have Ted on here. I also just wanted to put up two charts that you and John had sent me, Mike, just because you guys were talking about, how overvalued markets are. One is a new chart, and we've been putting up many in past weeks. Here's just the latest flavor, showing how overvalued this market is. This is a chart of U.S. equities based on price to sales, and it is at the highest level on record at 2.7 times. It is trading in the 100th percentile of its historical distribution over the past 40 years. So if you want to know, okay, roughly how overvalued are U.S. markets, they are 100% overvalued. They are at the maximum reading of the scale. So, if you're someone who's sort of trying to look at data to judge, okay, are we at a period of high risk or low risk? This is one of those incredibly bright flashing lights that's saying we are in a very, very high risk market. The second chart I want to put up here real briefly is, it's almost kind of cute putting it up now after what Ted said, but it's a chart showing how many bonds are currently trading at negative yield and how much debt's trading at a negative yield, because we were talking about the impact of ZIRP. It's above 17 trillion, which is back near its record high. I thought that was going to be a relatively important chart because we were talking about how pensions can't get that much return off of their bond portfolios. But Ted told us they're not even that invested in bonds anymore, which I think is way scarier than what I meant to do by showing that chart in the first place. It is just so frightening and disheartening to learn from an expert like Ted how much risk is currently being taken on by these pensions, which really have a charter of being very conservative and good stewards, dependable stewards, because there's lots of people who've worked their whole lives that are depending upon the payouts of these pensions. So I think we've probably beaten the horse to a bloody pulp at this point in time. But markets are at crazy valuations. Even at these valuations, the pension funds are still, I think as Ted said, on average about only 70% funded. And that's assuming a continued annual rate of return of around 7%. Given these incredibly distorted levels of valuation, I think it's very reasonable to think that the Hussmans of the world could be right, the Granthams of the world could be right, and we could see a 0% annual return over the next decade. But just imagine if that return becomes decidedly negative because all of a sudden there's a massive clearing event and the market loses 50% or more of its value, which you said is possible, right? I mean, it would be Armageddon for a ton of these pensions. So not trying to deliberately freak people out, but I just want to make sure that people are aware of what's going on here, because as Ted said, the spotlight's sort of been taken away from the pension crisis by the pandemic and the elections and a few other things. But I think it's highly, highly likely that it's going to be headline news again, probably faster than we all would like and probably even can imagine. So Mike, real quick, as we wrap up here, anything to say about what the market's done since we met last week?
Yeah, just a quick thought add on to what you just said. And, I certainly, it is all about the market. Sadly, it's all about the market. Central banks and politicians are using the market to signal the sense of well-being to everybody. And frankly, it's just not a fair or just system. So, hopefully we can see some normalcy in these markets. We can start to have some more price discovery and have more to talk about, frankly, because you talk about just a minute ago in Ohio or any pension, frankly, even if they find a problem, what are their choices? They can take even more risk, which is probably not going to end well. They can cut everyone's benefit. They can say, 40 or 50 or 60% of what you used to have is what you're going to get now, or they can go to the federal government for a bailout. So the only thing I could really think that could work for a pension plan that found out earlier than everyone else that they've got a problem is maybe they'd be first in line. asking for the funds.
Yeah, there's
So,
a first to the trough incentive there, which
yeah.
means that when one or two start waving their hands and saying, hey, we're failing, you can predict that a ton of them are going to, because they
Oh.
want to try to get something while the getting is good, right?
So the crowdfunding people, they may be onto something pretty smart there, but just maybe 60 seconds on the market. Not a lot exciting to talk about, and I know we feel like we say that almost every week, but it's true. The markets are still near their all-time highs. The S&P is up about 45 points or so relative to when we talked last Thursday. If you look at a weekly or a monthly chart of the S&P 500, we're sitting on top of a long uptrend channel, just what's called a throwover in charting terms. We basically popped out of a channel and we're just sitting there right at the high. This week is an inside week, meaning we're trading inside of last week's range because we had that big jump on Monday and then we went lower during the week. And so we're inside of that range. And normally that would mean a consolidation or a coiling or, a market that's regrouping, looking for the next move. Who knows? I mean, we literally stopped trying to figure out what's going to happen next week, next month. All we can tell you is that we remain at the single most overvalued point really in U.S. history by almost basically any statistically reliable method tells you that. We talked to hundreds of people and we can tell you the sentiment out there is very, very bubbly. The feeling is like, well, it's gone on so long, who's to say it's ever going to stop, or the central banks will ever let it go down? The central banks won't let it go down, is what almost everyone thinks. And that is the pure textbook definition of a bubble. Everyone's in, even the people that are doubting it are pretty much in and doubting that it can ever go down. We know what that feels like. This is pretty much interminable. But I think if you really look at a monthly chart of the S&P, you see that we're tracing out this 3-year megaphone pattern where the market is just kind of writhing to and fro and frankly is very dangerous here. So the S&P is up 45 points over the last week. Volatility is down a couple points, down at like 23, still relatively high, but lower. And the 10-year Treasury note is something we're really watching closely. I mean, a week ago, it was knocking on the door at 1%. It was at 0.85, 0.87. That's actually come down a little this week to 0.79. It doesn't look like anything other than a consolidation. We still expect the yields to start climbing higher. And frankly, that's probably going to be the surprise. If we start seeing yields climb higher and inflation tick up, that could be a major surprise that markets aren't thinking of. And, a lot of people think that if we start getting inflation, that's going to be good for stocks. It isn't true. If we start getting inflation that's unexpected, history shows that stocks will get hurt or even crash first. Maybe long term, they'll go up if there's hyperinflation, but not right away. And gold is down about $10, and mining shares are weak. We've got some pretty good protection on our position. In fact, we're in the money on some put options, meaning that we don't have any further downside, at least at the very moment. Because of that, the pullback in miners is a little deeper than we expected. But, that's why we have protection there. And, we would expect that we will see a bounce soon. But until it happens, it's something we're watching closely.
All right. Well, I'm glad you mentioned it, because a huge reason why we have entered into this partnership with you guys, what we did a decade ago and continue to really value it, is your focus on risk mitigation and the way in which you use options to basically as insurance to protect against downside. It's very, very important. And I think people kind of get that, logically, but it really hits home when an investment they're in falls more than they expect, and they realize that they didn't lose money along with it because you guys had put them into some options that protected that downside. So really glad you drilled home on that. Just to your points, Mike, I wanted to add on 2 quick things as we wrap up here. One is you're seeing more and more like really storied veteran investors kind of capitulate to the same story that Mike is telling here, which is like, look, even though prices are high, like this is crazy to me. It's unlike anything I've seen in my career. I think the last guy to say that this week was John Malone, who I think owns more real estate than almost anybody in North America. And he basically said that he is sort of doubling down now on his hard asset investments in farmland and other types of commodity producing ventures and whatnot. So he's going full hard assets, get out of stocks, get out of paper, go into hard assets. And of course, he's just the latest one to do that. The other thing I want to mention is Bitcoin. So Bitcoin has been on a tear lately, and I just put up a chart here of it, but you'll see that it's more than tripled since its bottom in March, and just less than 2 months ago. So probably about a month and a half, we interviewed a Bitcoin expert, Alex Saunders, on this program, and Bitcoin's gone up about 75% in just the time since we interviewed him. So really interesting moment in its development, and it looks like it's certainly heading in an exponential direction. The question is this another blow off top like we saw at the end of 2017, and there's lots of people on that side of the boat, or is this big money coming into Bitcoin, the moment that all the crypto people have been waiting for when it gets legitimized as an asset class, and you get a lot of capital flowing into a relatively tiny market, sending Bitcoin exploding to the moon. And of course, there's a lot of people on that side of the boat too. So I don't really have a prediction to make one way or the other there, except to say whatever happens, we will track it, and we will bring additional crypto experts back in if indeed this looks like kind of the next chapter for cryptocurrency. With that, Mike, we'll wrap things up here. Folks watching, I'm going to ask something I haven't asked beforehand. I will try to remind you going forward, though, which is if you haven't, every week I ask everybody just to click the like button, and please do that if you haven't. Likes actually matter in how widely these videos get shared. But what's really important for YouTube is the number of people that subscribe to our channel. So if you haven't subscribed yet, hit the subscribe button. It's right there by the like button. There's a little bell next to it. If you see that, click that bell. If you do, you'll get alerted every time we post a new one of these videos. But make sure you subscribe to the channel if you haven't already. Again, I post who our future guests are on this program on Twitter before we actually film the video. So if you want to find out who we're going to interview next, follow me on Twitter at @MenloBear. If you have any guests that you'd like to see on this program, Twitter is the place to suggest them to me. I monitor that feed. And then lastly, hopefully this conversation really drove home the staggering amount of risk that's in the system that many of us, are unaware of, right? I don't think pensions was probably on the top of many people's minds today before they started watching this video. Ted underscored the real need to work with somebody who can take that big risk into account when devising a portfolio strategy. So if you or anyone in your family is planning on receiving the benefits of a pension, or if you're one of the many, many people who aren't getting a pension and have to save enough money to live off of in your retirement and are having trouble doing so in a 0% environment, highly, highly recommend, can't recommend enough, talking to a financial advisor who understands those risks and can help you create a investing strategy, taking them into account. Now, we officially endorse Mike and John and the team at New Harbor Financial. They offer a free portfolio review consultation for you. They'll look at all your financial statements, your financial situation, and they'll give you their advice on what they think you should do. And that's all for free. There's no requirement to work with them. It's just a public service that we offer. If that's of any interest to you and you haven't done it yet, or if you've done it but you haven't done it in a while, stick around at the end of the video here. We tell you how to do that. It just takes a couple of seconds to schedule an appointment with them. And with that, Mike, thanks so much for another great discussion, another great week. And I look forward to doing this with you next week. We will be promoting this, we'll be issuing a new video during the Thanksgiving week. So if you're on your turkey break and at home and have extra time, don't worry, we're going to give you another great interview. And we've already lined up the guest. He's amazing. You'll be very impressed that you can watch next week. So with that, Mike, I'll see you in a week.
Thank you, Adam. See you next week. Thank you.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.